Would you like to learn how to use an option spread to trade what we call a volatility breakout? Hi, I'm Larry Gaines, Power Cycle Trading, and in this video I'm going to show you how to use a vertical call option debit spread to trade a defined risk trade with good leverage to trade a upside move on something that we call a chart pattern called a volatility squeeze breakout. So this is IWM, the Russell 2000 ETF, and this is what we call a volatility compression squeeze. So these dots are programmed into our system to show when a squeeze based on our trading rules starts. And so the squeeze starts and it's kind of a compression of volatility coming off, and then we're looking for an explosive move either up or down. So the thing that's interesting here is that on the weekly time frame we've got a volatility squeeze on the Russell. So you can see right here a really good squeeze. So it's been kind of in the sideways pattern since February 2017. And right now you can see it's starting to push up to the upper end of this channel with what we call this volatility squeeze. So this is on a weekly. Now, if this triggers, and right now we've got solid momentum to the upside, so the probability is for this to trigger to the upside. We've got a volatility squeeze here today on the hourly that just triggers. So it's kind of like dominoes. You get a lower time frame here, triggers, that triggers the daily triggers the weekly. And then we've got the weekly in a time, the daily also in this volatility squeeze, very close to triggering right here. We've got what we call momentum, powerful momentum. So all four time frames of our momentum flow indicator are up. So good probability for this to break to the upside. Now the target then, based on Fibonacci extensions, is for a move up here to 144. So that would be the first target, 144, based on the 1272 extension, and then we've got a bigger target based on the weekly. So then based on this weekly chart pattern from that swing high we had back in June of 2015 low, we hit the 1272 at 138.60. Next major target then is 150. So the way to play this, one way to play it for really defined risk but good leverage, is using what we call vertical call debit spread. So went out to the August monthly, so that's the August 18 series, and looking for a target to 150. So put this target on the spread at 148 to come in before 150, but you could widen the spread if you want. So set this up a $5 wide spread, 143, 148, and this is what we call a vertical call debit spread. So long the 143, short the 148. August expiration, put it on $1.55. That's your max risk. So your risk, maximum risk to the downside is 155 premium paid. Potential theoretical max profits 345. So nice positive risk ratio, and you can take profit all along in between. So this is a really great way to trade a breakout trade, give yourself leverage and define risk using a vertical call debit spread.